it with rocket fuel for companies investing? Is that?
Well, we'll see. I mean, my own view is if you look at a story.
Hello and welcome to Bloomberg Quint. You're watching the fine print. Honesty is indeed the best policy. Holds true in life as well as for India's competition law. In a first, the Competition Commission of India gave Panasonic Energy full immunity even after the company was found guilty of cartelising in the dry cell battery market in India. The regulator found that between 2008 and 2016, India's three leading battery manufacturers, Eveready Industries, Nippo and Panasonic Energy, colluded to fix prices, limit supply and allocate market. The Association of Indian Dry Cell Manufacturers aided in this conduct as well. On the three companies, the CCI imposed a penalty of 1.25 times their profit. And here's where CCI's lesser penalty regulations played their part. Also known as the leniency regime, it encourages cartel participants to admit to wrongdoing and disclose to the regulator the existence of a cartel with adequate evidence. In exchange, based on the quality of evidence, the regulator can give full or partial reduction in penalties. In the case of dry battery manufacturers, Panasonic received a 100% reduction in penalty, Eveready Industries 30% and Nippo a 20% reduction in penalty. The regulator pointed out that the penalty was reduced based on the evidence and assistance the three companies provided during the investigation. So what does it take to get a 100% immunity from the CCI? Karan Chandhiok, who represented Panasonic Energy before the CCI, joins me to answer that. Karan, the starting point for the CCI investigation was an application by Panasonic. How did that come about?
Well, like many other multinationals, Panasonic has a very robust compliance program, including for competition law. So, as with most compliance programs, the first job of a good compliance program is to make sure that it not only prevents but also detects if there is any anti-competitive activity that takes place. So, with the case of Panasonic, its compliance program did detect that there was perhaps an anti-competitive cartel-type conduct taking place. Panasonic, as a consequence of that, it has a very global, very strong policy for reporting anti-competitive conduct and bringing them to an end. It went out and sought external help. We got consultants were involved, both from legal side as well as some forensic consultants. After the evidence was collected and we had confirmation that there was cartel that took place, the next job was to come clean to the CCI and bring it to their attention.
Okay, what happens in these audits, Karan? How do you usually figure out that there is some sort of anti-competitive conduct that is going on inside the company?
Well, there are various ways to actually go about it, but I think what's been very effective, at least in our experience, is to have a very robust whistleblower policy where a whistleblower is protected and their identity is, his or her identity is kept of course, confidential. And so during the trainings that take place as part of a compliance program, whistleblower individuals are encouraged to bring about questions, ask and bring about sort of conducts which they may think may be borderline on the case of being a cartel or any other anti-competitive conduct for that perspective. And if there is a whistleblower, then as a consequence of that, typically firms would either do an internal investigations based on their own in-house legal team and HR teams, or they would go and seek out external help to conduct an investigation and audit. The other way of going about it is to have regular audits of the company, and to it's very much like a due diligence exercise where you're seeing where interactions are taking place between competitors, where you're seeing whether or not pricing policies, what are the back end discussions taking place for pricing decisions, supply decisions, so on and so forth. So the various ways where one can go about doing an audit, but the first and foremost is that companies and their employees should know what anti-competitive conduct is to come forward.
Okay, so when you first filed this application with the CCI, what sort of information did you share with the regulator? And as the case progresses, what additional evidence are you required to hand over to the regulator?
So the key aspect of the lesser penalty regulations is which really articulates the entire ecosystem under which an applicant can go and make a disclosure to the CCI, requires that there should be the information that is provided to the CCI is true, vital, and complete. So in that respect, from the CCI, what really the CCI expects on day one is that all information which the applicant has, that information goes into the CCI. Of course, it has to be true and correct on all aspects. So in terms of, and this is also reflected in the order of the CCI itself, which is that the information was provided by Panasonic included details of drawings, included details of press releases, email exchanges that took place during the course between the competitors, which was reflective of anti-competitive conduct. The other set of information was the information that was actually being exchanged through, as you mentioned in the beginning of the program, through the All India Dry Cell Manufacturers Association, and that in fact helped in facilitation of the cartel.
Okay.
Going forward to the next part of your question, the information that is required to be part during the course of the investigation is what the obligation on the party, on the applicant, is to do continuous cooperation with the CCI. So in most cases, because there is a race to make the application to the CCI, parties may not have the complete picture at that point. So what typically happens is that you will go in and file an application based on evidence which supports a theory that there is a cartel that has taken place, and then you would try to better that information during the course of the investigation. So there's a constant digging at the end of the company as well, and the investigation of the company does not just come to an end when the application goes to the CCI. There's continuous sort of digging around that takes place, and as and when new information comes to light, that is forwarded to the CCI as well.
It's not forthcoming in the CCI order, but I'm just wondering that during this investigation, does the regulator or does the Director General also use the first applicant to try and get more information out of the other cartel members, and then you are then working at the behest of the regulator in any fashion? Was that also sort of expected of you?
Well, the regulations does provide that the CCI can go ahead and say that the first applicant shall continue to take part in the investigations. Yes, it's not forthcoming in the order, and I don't think it would be appropriate for me to go into those details, but what is important from a first applicant, irrespective of any investigation, is that the information that is provided is actually put to the second and third applicant. So let me take an example. So if there is an email which the first applicant has provided, then to the other opposite parties, that email would be put to them and made to them to answer. So this has happened in various investigations. The dry cell is no exception to that, where what the Director General does is uses the information which has been provided. So as I gave example of an email, so the Director General will then summon the entire email box of the applicant, use the information that is there in that email box, and then confront the other participants. And that may actually lead to other participants coming forward and actually admitting to the cartel as well.
Okay, and then when all the cartel members join in and are aiding the investigation, what sort of challenges did you come across in this particular case?
Well, I think the most fundamental part actually started at the very beginning of the case, which is where everybody now realizes that there are severe penalties on individuals that take place, and of course the reputational loss that comes with it. So the biggest challenge for any of these cases is to make sure that the employees, some of them may be actually former employees, are actually cooperating with the company to make this application. So for us, the challenge was always to ensure that all past and present employees were were open to the idea that we will be going or we would be making an application to the CCI, and perhaps their name would find their way eventually into the order, which it does. So for us, for any company, the real repository of the information is the employees. The first challenge is to get them on board. The second is, in this case, of course, there was the CCI went ahead, or rather the DG office went ahead and did a dawn raid. So it was important that throughout the entire process there was cooperation, and if there was any assistance that the DG or the CCI required, we would be available to do so.
Okay, and once you convince these individuals to, sort of confess and, help with the investigation, are you assured at that point in time that the immunity will automatically be extended to them?
Under the old regulations, so at the time when Panasonic had gone into the as an applicant, there wasn't clarity on the regulations. The regulations have since been amended in August of 2017, which now clarified that those that not only the enterprise but individuals of the enterprise will also be extended the immunity or whatever lesser penalty reduction that may come from. What the applicant is required to file is a list of individuals who have been part of the process, and those individuals will get the benefit.
Well, thanks, Karan, for throwing in some light on the quality of evidence that's required to get 100% immunity from the competition regulator. Moving on. In an important ruling, the Supreme Court of India has thwarted the Revenue Department's attempt to tax loan write-offs. Experts say that this apex court ruling will have implications for companies facing insolvency proceedings. In the last couple of years, companies such as JSW Steel, Mahindra & Mahindra, Jindal Equipments and several others have got different outcomes for the same problem, thanks to the differing High Court rulings on whether loan write-offs can be taxed by the Revenue Department. In all these cases, the Tax Department had sought to tax the principal amount of the loan in the hands of the borrower once it was waived off by the lender.
So the sum and substance is, whenever a loan is being taken by the borrower and whose end use is to meet the capex requirement, whether the waiver of such loan by the lender will tantamount to income in the hands of the borrower or not. That's a short summary of this particular bone of contention in this particular case. Waiver by the lender of a loan whose end use is basically nothing but to finance the capex of the borrower, whether such kind of waiver will be taxed under the Income Tax Act or not.
The Bombay and Delhi High Court had answered this question in the negative. The courts had held that a loan which is originally taken for capital expenditure, if waived, will not give rise to taxable income either under Section 41(1) or Section 28(4). These are the two sections under the Income Tax Act which the Tax Department had used to make its case. Section 41(1) says that if a taxpayer has availed of a deduction as a result of loss on a trading liability and in any subsequent year the creditor waives this liability, then this benefit will be treated as income. Section 28(4) treats any benefit, whether convertible into money or not, arising from business as profit that would attract tax. It's under this section that the Madras High Court had held that waiver of a portion of the loan would tantamount to a benefit.
The courts primarily took the view that since this is a benefit in cash, it is a monetary benefit, therefore it is not within the scope of Section 28(4). Now the Delhi High Court, you have divergent views from the Delhi High Court as also the Bombay High Court. Originally the Bombay High Court was in favor, but in a later decision in the case of I think solid containers, the Bombay High Court took a different view, and they took a different view in the context of waiver of a loan. And they said that when there is a waiver of the loan which is used for working capital purposes, that will amount to income.
The fact number one, which is quite important to any kind of a litigation under this kind of a matter, is what is the end use of this particular loan, whether for capex or for meeting any trading transaction or normal transaction of the borrower. Whether, second aspect, whether the borrower has actually taken a deduction in its books of accounts or not. If these two facts can be ascertained, without any ambiguity, then I think the Supreme Court judgment can be applied vis-a-vis Section 41 of the Income Tax Act, because this Supreme Court judgment is also based upon these two aspects. And in the Madras High Court judgment which you have just talked about is basically, in that particular judgment the SSC has taken a deduction. So since one of this particular fact has been negated in this particular in that particular judgment, therefore the Madras High Court has gave a non-favorable judgment vis-a-vis the Delhi and the Bombay High Court, which has given a favorable judgment only on account of these two facts.
But the Supreme Court made no distinction based on the end use of the loan. It held that for Section 28(4) to apply, the benefit cannot be in the form of money and has to arise from the business. And since waiver of loan does not amount to cessation of trading liability, Section 41(1) cannot be applied.
As you see, 41(1), the cardinal requirement is the amount should have been allowed deduction in any earlier year, and there is subsequently a remission of a trading liability, in which case in the year of remission the amount can be taxed as deemed income under Section 41(1). Now the principal requirement that the amount should be allowed deduction is not satisfied in the context of a loan taken, because a loan transaction is on capital account. You don't claim deduction when you borrow a loan. That is a balance sheet item. You claim deduction for the interest payable on the loan. So when the principal amount of loan is waived, since this requirement, this condition precedent of the deduction having been claimed and allowed for the principal amount of loan is not satisfied, Section 41(1) does not apply. And the court further added that loan is not like a trading liability. So there is no remission of a trading liability when there is waiver of principal amount of loan.
In this particular Mahindra judgment, there is one peculiar fact that the borrower has not taken the deduction of the interest, and the Supreme Court and the Bombay High Court at many places has recorded this fact that no deduction of interest has been taken by the impugned entity, which is basically nothing but a Mahindra entity. So assumingly, suppose this particular fact was not in this situation, or rather this particular fact was the against, that means the Mahindra would have taken the deduction of this particular interest. Now the question arises whether the income should be treated only to the extent of interest or the entire principal amount, because law is not that clear upon this particular aspect. If a deduction against a loan, that means deduction of interest has been taken against a loan, whether only the interest waived off will be taxable or the entire loan. And there could be a possibility where the lender is only waiving of the principal amount but not waiving of the interest amount, and the borrower has taken a deduction of the interest amount. So what will happen? Whether at all any principal amount can be added back. So this particular judgment does not give any kind of finding on this particular aspect.
Supreme Court took the primary view that Section 28(4) will not include within its ambit any monetary benefit. So if there is a waiver of principal amount of loan, notwithstanding the utilization of the loan, whether for meeting capital commitments or for defraying revenue expenditure, since it is in the nature of a monetary benefit, it is not a non-cash benefit, that cannot be taxed under 28(4). So therefore they did not deem it necessary to go into the distinction and the bifurcation that the courts had drawn between the user of and the end use of the borrowed money.
Experts say that this apex court ruling will be useful for insolvent companies and their potential investors, since loan write-offs are a standard feature of any resolution plan.
This ruling is welcome in the sense that it settles the controversy once and for all, that on waiver of the principal amount of loan, notwithstanding again the end use of the borrowed funds, this amount will not be taxable as the income of the company, of the borrower company. So to that extent, it will help the plans of reviving even companies which are under the insolvency code, by saying that the white knight who steps in will actually not be having to pay tax on the amount of the haircut that is extended by banks, other institutions, qua the principal amount of loan.
Insolvency companies can certainly take advantage of this particular judgment, and rather I will divide the insolvency companies into two parts. The first category, who has not even paid the principal as well as the interest, and the second category, who hasn't paid the principal amount but has paid some amount of the interest to the lenders. The reason why I have divided into two categories, because the first category, which has not paid not even a interest as well as the principal amount, and the entire loan, that means that means the principal as well as the interest amount gets waived off, they certainly can take benefit of this particular judgment without any ambiguity. But the second the second category, who has actually paid some amount of interest but not even a single penny on account of the principal amount, that needs to be seen to what extent they can actually take advantage of this particular judgment. Obviously, the taxpayer, that means the borrower company, the IBC company, will try to seek advantage of this particular judgment in those cases also. But to my mind, the tax department is bound to, or rather is going to litigate by making a distinction of this particular Supreme Court judgment, and they might argue before the High Court also this particular Supreme Court judgment cannot be relied upon by the taxpayer, because this particular judgment is based upon the fact no interest deduction has been taken, and the law is still open for the interpretation in an event interest deduction has been taken.
While it's too early in the insolvency regime to anticipate similar demands from the tax department, the ruling will be useful for insolvent companies if it comes to that. Keeping with the insolvency theme, MS Sahu, chairman of the Insolvency and Bankruptcy Board, told Bloomberg Quint earlier this week that even though courts have directed creditors' committees to allow late and losing bidders to participate, and some in India Inc. have suggested that e-auctions should be followed in the bidding process, going the auction route is not the best idea. Here's a slice of that conversation. You can read and watch the full interview on Bloomberg Quint's Law and Policy page. Thanks so much for watching. We'll see you next week.
See, the law requires value maximization of the corporate debtor. It does not talk about value maximization of a set of stakeholders. Second, as I told, it is a resolution plan. It's not a bidding or auction mechanism which will come if the company does not go through resolution successfully and it gets into liquidation. At that stage, there is a provision for auction or bidding. The intention at the resolution stage is not a bidding or auction, it is a resolution plan, and that is why the law provides so much of support to make a resolution happen.